Music historian Ted Gioia says that the song investment fad is over. But is this true? Well, let's explore. But before I do, Ted is a cultural critic, a record producer, a jazz pianist, and he's also an author of many books and a newsletter that I've been reading for a while now called The Honest Broker. I really like his work and I usually agree with him most of the time. But late one night in October the 2nd, he shared a tweet, and that tweet said, "Here's more evidence that the song buying investment fad is over. Only a few buyers remain, mostly major labels who are gradually turning into IP management companies. Song values are dropping markedly." Now, I really want to dive into what he said, but before we do, let's share what I said. I then responded to his post and said, "Respectfully, Ted, this isn't entirely true. Investments in catalogs slowed in part due to interest rates. There's been 3 catalog sales announced this month. Now that interest rates have lowered, there will be more sales outside of the major labels. It's not over." And then I ended up sharing 3 of those announcements that I mentioned in the tweet. And those 3 were all done within a month of each other. Ted then responded and said, "This makes no sense. Stocks have risen during the period of rising interest rates. So have many other asset classes. Most investment funds have prospered during this period of rising rates, but asset bubbles are fueled by low rates and they do collapse, which is what happened in the song buying mania." Okay. Let's stop right here for a moment. Let's go back to his first tweet where he mentioned Pink Floyd's recent catalog sale. In the tweet, he included a graphic that said, "In 2022, experts claimed that Pink Floyd's song catalog would sell for more than $550 million. Today, the sale was announced at $400 million. Now, I'm not sure if Ted is implying that the band didn't get the $550 million they wanted because of the market and the state of catalog purchases. But I want to note that Variety mentioned that one of the songwriter's controversial political comments most likely devalued the catalog. Now, let's go back to what he said about the song investment fad being over. Okay, as I'm recording this, we're 9 days into October and there have been close to 35 catalog acquisition deals or partnerships that have been announced since the end of December of last year. I say announced because, as you know, some deals aren't announced. So what this means is an average of 3.5 deals are announced per month within the last 10 months. So my question to you is, does this seem like the trend is over? I'll let you answer that question. But next, let's go even further. So next, Ted said only a few buyers remain, mostly major labels who are gradually turning into IP management companies. Song values are dropping markedly. Okay, so Ted was right about the major labels turning into IP management companies, but let's go into more detail. He said only a few buyers remain, mostly major labels. Not sure what companies or investment firms Ted is referring to here, but there are only 3 major labels. And within the close to 40 deals or 35 to 40 deals I mentioned that were announced this year, 29 were from firms outside of major labels. Here's some data. Primary Wave, Harbor View, both led deals that they announced this year. Between them, a company called Iconoclast, Reservoir, and Pop House all had multiple acquisitions this year. His last line about song values are dropping markedly, there's no data to prove this, and I believe it's gone up since 2018 and continues to be more valuable. Now, remember, when I responded to him, I told him respectfully the interest rates contributed to less deals happening. He said, "This makes no sense." Now, he said more, but let's address this part first. I'm not sure if Ted thought I was just making this up, but this was a particular area that I was familiar in. I wasn't the only one saying this. Here's a headline from the Wrap that stems from a piece that the Financial Times did. Music catalog boom slowed as Wall Street trio bailed amid interest rate hikes. The article read, rising interest rates puts a freeze on the purchases of music catalogs by private equity-backed businesses, the Financial Times reported. Wall Street giants KKR, Apollo, and Blackstone have pulled back on their promises to fund big catalog buys, still not spending the $3 billion they collectively pledged in October 2021, in large part because of the rising rates made it harder to justify loading up on the assets with the amount of debt they had planned to use. So if we go back to Ted's tweet, the next part, he said stocks have risen during the period of rising interest rates. So have many other asset classes. Most investment funds have prospered during this period of rising rates. But asset bubbles are fueled by low rates, and they do collapse, which is what happened in this song buying mania. The article quoting from the Financial Times said higher interest rates also serve to make more traditional financial investments more attractive. Not Zalika, a former KKR partner who had led the firm's move into music, told the Financial Times, which has shifted private equity firms' attention away from music investments. I actually mentioned how other asset classes weren't like music assets, but I'd assume Ted knows this. The article continues, as a result, their interest in less liquid, less understood asset classes has waned. They ended by mentioning music is near the top of that list. Now, the Financial Times weren't the only publication saying this. I mean, you can Google it. Every article will tell you the reason for the slowdown in catalog investments were interest rates. But again, Ted said this made no sense. Let's go back to a Illuminate article. Part of it reads, as 2023 winds down, we're taking the opportunity to look back at some of the noticeable milestones we've hit in the music industry, as well as a look forward to what is to come in 2024. Though things have cooled down somewhat relative to the spree of blockbuster catalog deals just a few years ago, investment in the music space remains strong and continues to attract more players. From large institutional investors partnering with established music companies to upstart services to individuals who can now buy shares of music catalogs via innovative new platforms, there has been a consistent uptick in both active and passive investors. And despite the uncertain macroeconomic environment and rising interest rates, the catalog transition market has maintained solid, stable multiples over the last couple of years. According to Alistair Moggan, founder of Moggan Music, rising interest rates have reduced the number of catalog deals closed in 2023, as well as high-end multiples paid. A few of the more passive financially focused catalog buyers have cooled down as higher interest rates make the passive investment play less appealing in the short term. However, there is a very engaged pool of catalog buyers who are focused on acquiring quality catalog, especially when the underlying copyright is included in particular genres and demographics which appeal to them, and their ability to create value from the catalogs. The business generally seems to have slowed to a sustainable and engaged jog rather than the hectic sprints of the peak back in 2019 and 2020. Constant growth in streaming, along with hard-won increases in the publishing royalty rates, have helped to offset costs of debt to some degree. But perhaps the larger consideration when it comes to investment, note the royalty rate for songwriters increase and will be continuing to increase until 2027. Hint, back to my point about as far as the value of songs rising. Lastly, even Merrill Lynch noted high interest rates are affecting acquisitions while music streaming continues to change the business model. So again, I want to reiterate that I like Ted's commentary, but his thoughts on song values and catalog sales are not based in fact. So if anyone asks you if the catalog acquisition phase is over, don't take my word for it. Just look at the market. There are plenty of deals happening now. As I said, 3.5 deals are happening per month on average. The Fed recently lowered rates, so you can expect that number to increase dramatically, in my opinion. Obviously, you can watch to see if I'm right on that. But look, sometimes I'm wrong. We all are. But when it comes to this subject, I'm pretty spot on. Looks like what I did say did make sense.